Let's take a moment to introduce a very important concept, which is tax-smart investing. There are two types of money. There's retirement money, which is often referred to as qualified, meaning qualified for retirement. And those accounts are accounts such as individual retirement accounts or IRAs or 401ks. And then there's non-retirement money, commonly referred to as non-qualified. Much of the investing public knows of non-qualified accounts being conventional so-called brokerage accounts. When we deploy money in a non-retirement portfolio, how we actually build and implement that portfolio is really important and needs to be driven by the tax return profile. Because depending on the type of structure that is introduced into the portfolio, that particular investment holding may be remarkably tax inefficient, or alternatively, it could be very tax efficient. Broadly speaking, actively managed mutual funds are tax inefficient. And I want to talk about that. With an actively managed mutual fund, it's common for these mutual funds to kick a capital gain distribution onto an investor's tax return, specifically on what's referred to as the Schedule D. It's very common for individual investors to approach me and share that one of their largest pain points is the annual capital gains tax drag that they have on their tax return. When I look at the tax return and I see the large capital gains on the Schedule D, and then I go over to the investment account statement, for clients that have those large annual capital gains tax drags, it's very common to see that their non-retirement, meaning their non-qualified portfolio, is comprised largely of individual, actively managed mutual funds that are very tax inefficient. It's very important to understand that if you have cash in a non-retirement account and you want to invest that cash, choose the investments that are as tax efficient as possible given the tax return profile. For example, if the client is in an above average tax bracket, we generally don't want to have the portfolio comprised of very expensive, tax inefficient mutual funds. One of the common mistakes that I used to see financial advisors make time and again is that for their high income earning and high net worth clients, they would build the client's non-retirement, meaning non-qualified portfolio, largely of these expensive tax inefficient mutual funds. And that might not be a problem in years 1, 2, and 3. But you fast forward years down the road, as these mutual funds have appreciated and grown over time, that means that they have the potential to kick these big capital gains tax drags onto the Schedule D. And it is very commonly a pain point for the clients that come to our firm. There are different ways to transition a portfolio from an expensive, tax inefficient mutual fund based portfolio to a lower cost, significantly more tax efficient portfolio using tax bracket management and a handful of other strategies over time that allow us to reduce the tax drag of the portfolio, either by using individual equities or exchange traded funds, commonly referred to as ETFs. But ultimately, it's very important that you understand what your tax return profile looks like, both in the current year and in the future, so that you as a self-directed investor or you as a client of a financial advisor can ensure that you do have a tax-smart portfolio. When it comes to tax-smart investing, one of the best times to exit out of an expensive, tax-inefficient portfolio to transition into a much lower cost, more tax-efficient portfolio is when capital markets are down. In 2022, the Federal Reserve raised interest rates from 0 to 4.5% in under a year. The implications of that for stock and bond markets are widely known, because we're able to see in hindsight the effects that the interest rate increases had on capital markets. One of the common things that we read is that when markets go down, we're not supposed to make any knee-jerk reactions or blow out of certain investments in our portfolios if we're long-term investors. And while that is true, let's say we have a portfolio model that has a particular allocation. If there are expensive, tax-inefficient mutual funds in that portfolio, we can convert from the aggregate cost basis, meaning what's on the statement, what shows the unrealized gain or loss, to what's called a tax lot specific cost basis. And the value of that is if we just look at our statement and we see a particular investment might be up 5% after the market sells off pretty significantly. While that aggregate position may be up 5%, if we've owned that position for multiple years, particularly if it's a mutual fund, the capital gain, dividend, and interest reinvestments in the mutual fund each have their own tax lot, and those tax lots might be down. One of the common problems that I used to see when I consulted financial advisors is that the advisors would only do tax loss or tax neutral harvesting if full positions were down. But it's really important to know that if you convert from the aggregate cost basis to the tax lot specific cost basis, you can then see if there are specific tax lots that are at a loss, which allow investors to sell all of the positions that are down to maximize what's called tax loss harvesting, or to offset those losses with almost equal and offsetting gains, which is a process known as tax neutral harvesting. The end goal here is to exit out of the expensive, tax inefficient mutual funds to create as much cash as possible, not only to harvest losses and possibly offset those losses with gains that are equal and offsetting, but ultimately to exit out of the expensive, tax inefficient mutual funds to redeploy that cash into much lower cost, more tax efficient holdings. There's a long-term benefit there because if we look at time value of money and compound interest, if we have a hypothetical mutual fund that costs 0.8% or what's referred to as 80 basis points, and we open up the hood and we see what's underneath the portfolio in that actively managed mutual fund, in many cases, we can recreate that portfolio using either individual stocks or exchange traded funds, or possibly both. We can often do that at a much lower cost. For example, maybe 0.04% in an exchange traded fund. So if we go from 0.8% down to 0.04%, that's a significant savings for the cash that's created. And if we annualize that out over 20 or 30 years, and you can do the math on that, the larger the account balance, the more we're able to save over time, with the added benefit of reducing the unnecessary and forced upon us capital gains drag from the tax inefficient mutual funds that we were in. So while that is pretty technical, and please do forgive me, it's one of the many ways that by having a tax smart portfolio, they can keep significantly more in their estate working for them using time value of money and compound interest. And that's why I'm so passionate about this industry, and that's why I'm so passionate about educating the public. Because it's not that the models we've been talking about, meaning the portfolio management and the compensation models in and of themselves are necessarily bad. It's just that if a financial advisor is either outsourcing or delegating portfolio management, there can be a lot of value left on the table because there's no single human being or team of human beings that are scouring through the portfolio to make sure that tax loss harvesting has been done, maybe tax efficient harvesting has been done, maybe in a given year based on the the person's taxable income dropping significantly, we could actually do tax gain harvesting to get out of some tax inefficient, very expensive holdings. They're not looking through at individual positions to use to satisfy charitable intent with maybe doing our advice fund or a charitable remainder trust. So unless the client knows to ask these questions and to really understand the minutiae of the wealth management experience, they don't even realize the value that's being left on the table. And that bothers me. And that's why I wrote this. That's why I lecture. That's why I do media engagements, because the public doesn't know. And financial advisors are not required in the same way that licensed doctors are to follow the Hippocratic Oath.